The vast majority of people who engage in the great American or global dream of home ownership are trapped in a profound, yet rarely acknowledged financial paradox. We are conditioned to accept a 3-decade indenture, 30 long years of payments, 30 years during which the lending institution, the bank, holds effective veto power over our financial futures, dictates our cash flow, and ultimately extracts sometimes 2 or 3 times the actual purchase price of the home through the corrosive, insidious mechanism of interest. This acceptance, this resignation to the 30-year mortgage as an immutable law of finance, is the fundamental flaw in modern wealth building, and it is a flaw that we must aggressively challenge, not with minor adjustments, but with a complete systemic overhaul of how we view debt, assets, and monetary velocity. What if I told you that the common advice, the tired recycled rhetoric of making bi-weekly payments, of rounding up your principal payments by $50 a month, or of refinancing to a slightly lower rate, is not just inadequate but actively detrimental to achieving true financial independence? These strategies, while mathematically sound in reducing the total interest paid over 3 decades, fail spectacularly on the axis of time. They treat a structural, generational problem with trivial, incremental solutions. They guarantee that you remain on the bank's timeline, slowly chipping away at a mountain that is constantly regenerating itself through inflation and opportunity cost. We are not interested in shaving off 2 years from a 30-year sentence. We are interested in collapsing the timeline entirely. We are talking about taking a 30-year mortgage, the anchor tethering your future earnings to the past decisions of a government that perpetually inflates the currency, and annihilating it, liquidating that debt obligation, in 4 to 6 years. Not by winning the lottery, not by suddenly inheriting a fortune, and certainly not by practicing extreme self-punishing budgeting that strips the quality of life from the intervening years. This is not a strategy predicated on scarcity. It is a strategy predicated on abundance, velocity, and most importantly, asymmetric returns derived from a clear understanding of macroeconomics and the inevitable trajectory of monetary policy. To contextualize this challenge, we must first establish the conflict. The conflict is not between you and your mortgage balance. The conflict is between you and the current monetary architecture. When you secure a 30-year mortgage, you are making a massive bet, a gamble of your most precious resource, time, that the purchasing power of the currency you use to repay that loan will remain relatively stable, or at least that your salary growth will outpace inflation. History, recent data, and fundamental logic dictate that this is a losing bet. Governments burdened by ever-increasing debt loads have only one path of least resistance: devaluation. They must inflate the currency to make the debt less burdensome in real terms. This means that while the remaining nominal balance on your mortgage might feel heavy, the real tragedy is the opportunity cost. Every dollar you dedicate to a linear, slow repayment schedule is a dollar that is not being placed into assets that are engineered to accelerate exponentially in value, precisely because of the ongoing systemic devaluation. You are rowing slowly against a tidal current of inflation. The traditional financial narrative tells you to prioritize the guaranteed, low-risk return of paying off your debt. But what if the greatest risk is the guaranteed low-return pathway? What if accepting the interest rate of your mortgage, say 6%, is preferable to missing out on the possibility of assets that return 50%, 100%, or even multiples of that when measured in the devalued currency unit? The secret to this strategy is not finding a better way to service the debt. The secret is finding an asset class that is structurally engineered to benefit from the exact conditions that make the mortgage burdensome in the first place. You are not trying to save money. You are trying to acquire velocity. You are seeking leverage that is not borrowed debt, but rather market leverage derived from profound macroeconomic misalignment. Let us dissect the typical mortgage experience. In the first 7 to 10 years, virtually every dollar you send to the bank is pure interest. You are paying for the bank's profit, for their risk management, and for their overhead. Your principal reduction is minimal, barely noticeable. This amortization structure is deliberately engineered to ensure maximum stickiness and maximum profit extraction before the borrower ever builds significant equity. Your primary focus during the first crucial years must be to escape this interest tyranny, not through incremental payment, but through a massive infusion of external capital derived from superior asset performance. The conventional wisdom insists on minimizing debt. This is sound advice in a stable monetary environment. However, we are not operating in a stable monetary environment. We are in an environment characterized by unprecedented fiat currency creation, negative real interest rates, and an enormous structural mismatch between asset valuations, inflated, and the underlying economic reality, stagnant. To pay off a mortgage in 4 to 6 years, we must embrace a contrarian philosophy that dictates you must temporarily maintain the mortgage, allowing the debt to be inflated away in real terms, while simultaneously concentrating capital into specific high-torque assets that will deliver the exponential capital required for a final catastrophic principal annihilation. This is where the Sprott philosophy and the recognition of what constitutes the smart way comes into sharp relief. The smart way acknowledges that cash is trash in an inflationary environment, and fixed income assets are a guaranteed path to poverty. You cannot afford the leisure of long-term bond holdings or even overly diversified, passively managed index funds if your goal is rapid financial liberation. Those instruments are designed to track the general, moderate growth of the economy. They are not designed to exploit the structural failures that lead to monetary collapse. We need assets that are fundamentally outside the fiat monetary system. Assets that are priced not just based on supply and demand fundamentals, but assets that function as a direct inverse counter-trade to the rising quantity of paper currency. We are seeking assets that have an immutable physical scarcity that cannot be diluted by central bank policy. When the system is structurally unsound, you do not put your capital into the core components of the unstable system. You move it to the periphery, into the assets that become essential when confidence in the core is shattered. This transition in thinking is the single most challenging hurdle for most individuals. It requires accepting a higher degree of nominal volatility in exchange for a dramatically compressed time frame for wealth creation. We are moving away from the paradigm of slow, stable returns and into the paradigm of explosive asymmetrical wealth generation driven by macroeconomic cycles that are currently signaling massive distress and opportunity. Consider the compounding effect required. To pay off a $300,000 mortgage in 4 years, you do not need to simply save $75,000 a year. That linear calculation ignores interest, taxes, and inflation. You need a lump sum of capital derived from superior investment performance that can entirely overwhelm the principal balance in a single, decisive strike. To generate that kind of capital in a short period requires returns far exceeding the 10 to 15% annualized returns commonly cited in conventional financial planning. We need 25%, 50%, or even greater returns, compounded over 4 to 6 years, applied to a growing base of capital. Where do such asymmetric returns materialize with high probability in the current environment? They materialize in sectors that are deeply out of favor, fundamentally undervalued, and possess built-in leverage to an inevitable macro trend. When the currency debases, the assets that are the historical physical antithesis of debt and paper money perform the best. We are talking about the hard money assets. This is the foundation of the strategy. We must become owners of the things that governments cannot print. We must become owners of the physical, tangible assets that retain their purchasing power when the nominal value of fiat currencies evaporates. The most historically potent manifestation of this principle is found within the precious metals complex. Gold and silver are not merely commodities, they are monetary metals. They are zero-risk assets when measured against central bank insolvency and governmental overreach. However, simply buying physical metal, while a necessary defensive measure, does not provide the explosive velocity required to pay off a 30-year mortgage in under 6 years. Physical metal is the bedrock. It is the store of value. To achieve the required exponential growth, we must introduce operating leverage. This is the critical juncture where the smart way distinguishes itself from traditional asset allocation. Operating leverage in this context means utilizing the publicly traded shares of companies that mine and produce these physical assets. Think of a gold mining company. Its costs, labor, diesel, equipment, are incurred today. often in fiat currency. However, the price of its product, the gold it pulls out of the ground, is dictated by the global market price of gold, which accelerates exponentially during periods of monetary debasement. When the price of gold moves from, say, $2,000 an ounce to $3,000 an ounce, a 50% increase, the costs of the miner may have only increased by 5 or 10%. That remaining 40 to 45% difference flows directly to the bottom line, often resulting in a 2-to-1, 3-to-1, or even greater multiplier on the stock price compared to the metal itself. This means that a 10% move in the underlying metal can translate into a 50% move in the highly leveraged mining equity. This is the financial rocket fuel required for our objective. This is how you generate the massive concentrated capital required to crush a 30-year debt obligation in a fraction of the time. You are effectively leveraging the necessary instability of the monetary system against the stability of a physical asset's purchasing power, all amplified through the corporate structure of a mining company. The smart way is inherently volatile because it targets sectors that possess this extreme leverage. This is not a strategy for the faint of heart, or for those who panic during minor market corrections, but volatility, in this specific context and time frame, is the engine of wealth compression. We are trading the certainty of slow, debilitating inflation for the probability of rapid, highly leveraged deflation of the debt burden. The key is to correctly identify the point in the cycle where these leveraged assets are poised for their parabolic ascent. We are not paying off the mortgage, we are buying the means to pay off the mortgage, and we are buying them with the currency that is rapidly losing value. We are exploiting the system's weaknesses. The goal is to allocate a portion of your capital that would otherwise be wasted on marginal savings accounts or slow-moving traditional portfolios, into high-quality, undervalued mining equities that are leverage plays on gold and silver. This specific high-concentration allocation will serve as the reservoir of capital. Once this reservoir swells to match and ideally exceed the outstanding principal balance of the mortgage, the entire strategy culminates in a single surgical execution: the liquidation of the asset portfolio and the immediate full discharge of the debt. You transition instantaneously from a debtor shackled for 30 years to an independent capital owner with zero major liabilities. This is not a theoretical exercise. This is a tactical shift from being a sheep grazing in the field of fiat currency to becoming a lion hunting the specific assets that thrive in chaos. To execute this, we must precisely define the entry points, the quality characteristics of the mining companies that provide maximum leverage, and the disciplined execution of the final debt payment. The crucial next steps involve detailing the specifics: how to structure the portfolio for maximum leverage while managing the inherent risk, how to identify the premier junior and mid-tier explorers and producers, and the exact mechanics of the capital accumulation timeline required to hit that 4 to 6 year target. You need to understand the cyclical nature of these markets and how to deploy capital effectively to catch the accelerating wave. Prepare your mindset now. This is a journey that demands courage and conviction against the prevailing financial narrative. We are moving from incrementalism to exponentialism. We are moving from paying interest to demanding principal appreciation. Your path to annihilating that 30-year mortgage begins with this fundamental shift in understanding. Your debt is the bank's asset, and the only way to seize control is through the aggressive pursuit of counter-cyclical, monetarily scarce assets. We must now turn our attention to the specific mechanics of identifying and deploying capital into the engine of this strategy, the leveraged precious metals equities, to ensure maximum financial velocity over the next 4 to 6 years. This is where the rubber meets the road. We are shifting the discussion now from the problem of conventional mortgage repayment to the solution offered by optimized capital allocation, a solution that fundamentally redefines the relationship between debt and opportunity. If you walked away from the first part thinking this strategy was merely about investing your extra principal rather than paying it directly, you missed the critical nuance. The truly transformative power of this approach lies in the speed, the scale, and the timing of the capital strike. The average homeowner, disciplined enough to make an extra principal payment every month, feels a sense of virtue. They look at their amortization schedule and see those months ticking down, perhaps saving 5, 10, maybe even 15 years off the life of the loan. That is commendable, but mathematically it is inherently inefficient. They are essentially committing capital to a guaranteed return equal only to the low interest rate of their mortgage, say 4.5%. And they are sacrificing the time value of that capital. They are paying off today with capital that could have been earning 12% or 15% compounded annually for 5 years in order to save 4.5% interest on a diminishing balance. This is the definition of opportunity cost squandered, and it is the single greatest impediment to achieving true financial velocity. The smart way demands a psychological pivot. It requires you to view your mortgage not as a crushing burden to be chipped away at daily, but as a stable, low-cost financial foundation that allows you to deploy your accelerated payment budget, the money you would have used to pay down principal early, into a high-growth vehicle. This vehicle, which we shall call the Accelerated Freedom Fund, must be managed with the single uncompromising objective of achieving a return that drastically outperforms the mortgage rate over a defined, aggressive timeline. We are not talking about long-term, passive index investing for 30 years here. That is a fine strategy for retirement savings, but this is a targeted 5-year financial blitzkrieg. The goal is surgical precision, building a war chest, maximizing its compounding potential within a constrained time frame, and then deploying that massive lump sum to execute a definitive, immediate termination of the mortgage contract, often in the very first substantial payment made outside the regular schedule. Consider the baseline. If you have a $300,000 mortgage at 4.5% and you commit an extra $1,000 per month towards it, you shave years off the schedule. But if you commit that same $1,000 per month, totaling $12,000 per year, into a diversified portfolio aimed at aggressive growth, let's conservatively target a sustained 12% annualized return, which is historically achievable over a 5-year period if managed astutely and focused on value and momentum. The difference becomes staggering. In the conventional scenario, after 5 years, your $60,000 in extra principal payments has saved you 4.5% on the principal balance it retired, meaning your real financial gain, accounting for the compounding structure of the loan, is less than the $60,000 deployed. But in the Accelerated Freedom Fund scenario, that $60,000 compounded at 12% annually becomes approximately $81,000. You have effectively manufactured $21,000 of pure profit from capital that otherwise would have been locked into the low-yield security of the debt reduction. This is the central engine of the 4 to 6 year plan, leveraging time and superior returns to rapidly multiply the capital designated for payoff, rather than simply consuming that capital directly. The fundamental question must be addressed now. How do we accelerate this process even further to compress 30 years into less than 6? The strategy relies on 3 interconnected pillars that must operate in sequence, providing the mathematical leverage needed for the speed target. During the initial phase, the focus is meticulous saving and strategic allocation of the Accelerated Freedom Fund. This is not the time for timid market participation. Because the objective is debt elimination, a financial certainty, the risk profile of the fund can be calibrated more aggressively than standard retirement savings. We are seeking assets that demonstrate asymmetric upside potential. This requires deep homework, adherence to valuation principles, and potentially deploying capital into cyclical opportunities that offer outsized returns when timed correctly. We are aiming for double-digit returns, not 6% savings accounts. The discipline here is non-negotiable. Every dollar that would have gone to the mortgage principal goes into the fund. And critically, this fund must be treated as sacred. Its sole purpose is the eventual obliteration of the mortgage. This is the inflection point where compounding truly begins to work for us, not against us. Once the accumulated principal plus gains reaches a significant mass, perhaps $150,000, the returns generated in a single year can begin to dwarf the entire initial annual contribution. If the fund is sitting at $150,000, a modest 10% return yields $15,000 in passive growth, exceeding the $12,000 you are manually contributing. This transition, where the money starts working harder than the manual contribution, is the point of financial escape velocity. The key structural modification here is to ensure that all dividends, all interest, and all capital gains are immediately reinvested back into the fund, maximizing the compounding effect without ever withdrawing a penny. This ensures that the base of the fund grows exponentially, making the goal of paying off the entire mortgage principal within the target time frame mathematically inevitable, provided the target return is met. The critical mistake most people make when they finally have a large sum of money is using it to reduce the mortgage amount, thereby accepting a new, smaller monthly payment and continuing the amortization schedule. That is a suboptimal application of the capital. The true power move, the defining action that closes the loop on this accelerated strategy, is waiting until the Accelerated Freedom Fund has accumulated enough capital to pay off the majority of the remaining principal, ideally enough to reduce the LTV ratio to below 50% or even 30%. In some scenarios, depending on initial down payment and market performance, this fund may accumulate the full remaining balance. Let's model the ideal endgame scenario that fits the 4 to 6 year window. We started with $300,000. After 5 years of regular payments, the principal might be $280,000. Our fund, with $60,000 in contributions, has grown to $81,000. Now we are entering year 6. We decide the fund has reached the critical mass needed for the blitz. We liquidate $150,000 worth of assets from the fund, potentially augmented by the fund's continuing growth and the continued monthly contributions up to that point. We take this $150,000 and execute one massive non-scheduled principal reduction payment. This is the moment of maximum leverage. When you reduce the principal by a substantial immediate amount, $150,000 in this case, the remaining principal drops dramatically and the remaining amortization schedule collapses. The bank must recalculate the interest paid, and the financial gravity of the 30-year schedule is permanently broken. The reason this single large payment is superior to 5 years of incremental payments is simple. The financial institution cannot compound interest on principal that suddenly ceases to exist. While the incremental strategy pays off small chunks monthly, still allowing interest to compound heavily on the vast remaining balance, the lump sum strategy destroys the majority of that interest-bearing principal in one decisive stroke. But the strategy does not end there. We need to close the loop definitively within the 4 to 6 year window. If our $150,000 strike leaves us with $130,000 remaining on the principal, we have effectively reset the mortgage clock. But now we are dealing with a vastly smaller balance and vastly superior equity position. The remaining $130,000 can now be attacked using the remaining capital in the Accelerated Freedom Fund, or, and this is the ultimate tactical maneuver, by leveraging the dramatically improved equity position. If the market has been favorable and our home has appreciated, or even if it hasn't, our loan-to-value, LTV ratio has plummeted. We have the potential to immediately refinance the remaining small balance, $130,000, into a much shorter term, lower interest loan, a 5-year or 7-year note perhaps. But why bother with a new loan? The goal is absolute freedom. We must now re-engage the remaining capital. Remember, the fund was structured not just to reach $150,000, but to continuously generate growth. If we were aggressive, the fund might have been closer to $200,000 before the $150,000 strike. The remaining $50,000, plus any further contributions and growth in the ensuing 6 months, is immediately deployed to target the remaining $130,000. The final 2 years, years 5 and 6, become a focused sprint. The capital that was freed up by the low-cost mortgage is now deployed with extreme prejudice against the remaining debt. By shifting the timeline and increasing the velocity of the capital through market deployment, we achieve a situation where we are no longer paying the bank's interest schedule. We are dictating our own payoff schedule. This is the psychological breakthrough. You are not beholden to the 30-year schedule written by the bank. You are utilizing their money, the mortgage principal, as a cheap liability, while your capital generates high-return assets on your balance sheet. The mortgage is simply a controlled liability enabling the aggressive accumulation of a high-return asset base, which is then used as a financial weapon to eliminate the liability entirely. Think of it as having a financial partner that lends you money at 4.5% interest. but allows you to invest all your available funds at 12%. You simply wait until the 12% funds have grown significantly larger than the 4.5% interest liability, and then you pay off your partner. The net arbitrage gain is the difference between the rates, compounded and magnified over the compression of time. This is why the conventional advice of merely paying extra principal is financially myopic. It eliminates the beneficial arbitrage opportunity. We must also address the inherent risk. What if the market performs poorly during the 4 to 6 year window? This is a valid concern, particularly for a highly targeted strategy. First, the risk mitigation is built into the timeline. We are not gambling on immediate returns. We are compounding over 5 to 6 years, which significantly dampens the volatility of short-term market fluctuations. Secondly, the safety net is the mortgage itself. If the fund does not meet its target return, the worst-case scenario is simply defaulting back to the original 30-year amortization schedule. You haven't lost the original capital, the accelerated payments. It is still sitting in the fund, ready to be deployed when market conditions are more favorable or when the fund naturally grows back to the critical mass. You haven't incurred any penalty and your primary residence is secure, provided you keep making the standard monthly payment. This is the beauty of the structure. The mortgage acts as the ultimate stop-loss. It dictates the maximum downside time required, 30 years, while the investment strategy dictates the minimum required time, 4 to 6 years. The critical turning point, the climax of this strategy, is not when you write the final check, but the moment you realize the size of your accelerated freedom fund exceeds the total remaining interest payments you would have made over the life of the 30-year loan. When the assets you control are greater than the interest liability you owe, you have achieved financial independence in the context of that debt structure, regardless of the principal balance. When the massive lump sum is deployed, the mortgage is effectively dead. The amount of interest you save in the years immediately following that strike is exponentially greater than the interest saved in the first 5 years of incremental payments. This single action, the calculated strike, is the reason the timeline compresses so violently. The payoff is not just debt freedom, it is capital freedom. By executing this strategy, you have proven that you can manage capital to achieve significantly higher returns than your liabilities cost you. Once the mortgage is gone, the accelerated freedom fund, which might now have a residual balance or be immediately reconstituted with the money that was previously going to the mortgage payment, is now entirely free capital. This capital is no longer obligated to service debt. It is free to pursue true wealth creation, funding retirement, starting a business, or securing intergenerational prosperity. This 4 to 6 year strategy, championed by a mindset focused on mathematical efficiency and opportunity cost, is not about sacrifice, it is about acceleration. It replaces the slow, painful process of paying down cheap debt with the rapid leveraging process of growing high-return assets. It demands discipline, mathematical rigor, and the courage to ignore conventional, but ultimately inferior, financial advice. Your goal now is to run the numbers. Calculate your extra principal budget. Calculate the compounding effect over 6 years at a conservative 12% return. Compare that projected lump sum to your current principal balance. You will quickly realize that the 30-year term is a psychological constraint, not a mathematical necessity. Start building your accelerated freedom fund today. Treat that capital with the respect due to a powerful financial weapon, and prepare for the moment you execute the decisive, large-sum strike that achieves financial freedom in a time frame most people believe is impossible. It is not impossible. It is simply optimized.